Hi guys, welcome back to LGT Services YouTube channel. My name is Nicole and today we're going to get into some income and savings credits. These are the credits that are offered by the IRS in your federal taxes, not the same credits that are offered with your state taxes. So please keep in mind. Is the second part of the series. Our first part we discussed family and dependent credits. A few of these credits do overlap. Please be sure to check out the first video if you have some more questions about credits. Then later we will put out our third video, and in this video we're going to talk about some healthcare credits and 2 education credits. Okay, let's get into it. Our first credit that we're going to talk about is the earned income credit. We discussed this credit in the first video, family and dependent credit. The reason that we're discussing it kind of in both is because it is an income credit, but it is so heavily swayed for those people with dependents that the credit is just really beneficial for those people. For example, we have some income limitations, the amount of income that you have. Now this varies depending on how many qualifying children you have and also your filing status. For example, if you're a single head of household and widow with 0 children, you can make no more than $15,820. If you have 3 children, you can make $50,954. If you are married filing jointly and you have 0 children, it maxes out at $21,710. If there's 3 children, it can go up to $56,844. If you fall in the limitations that are dependent upon your earned income and your filing status and the amount of qualifying children you have, let's talk about the maximums of the credits. So if you have 0 qualifying children, regardless of your filing status, the maximum amount of the credit that you can claim is $538. If you have 3 children, the max that you can claim is $6,660. Again, as long as you meet the requirements with the filing status and the earned income, the maximum amounts of the credits does not change. This credit is a non-refundable credit, so it will only zero out your tax liability. Once that is zeroed out, even if the credit is not fully used, it ends. Okay, our next credit is the Savers Credit. This credit is anywhere from 50%, 20%, or 10% of the contribution that you make to a retirement plan. To determine whether you're 50%, 20%, or 10%, we need to look at your AGI. The maximum that this credit can be is $2,000 if you're married filing joint, or $1,000 if you are any other filing status. So if you max it out and you get the most optimal bits of this credit, you'll get 50% of the amount that you contribute. Let me give you an example. We've got Jill, she's married filing joint. She made $41,000 this year. Her husband is unemployed. She works at a retail store. She contributed $2,000 to her IRA. So she is able to claim $1,000 of a credit. Her adjusted gross income would be $39,000 because she's going to deduct the $2,000, and she's going to then apply the credit of $1,000 in her tax liability. So to determine whether you are going to be able to use 50% of your contribution, 20% of your contribution, or 10% of your contribution, we need to look at your filing status and your AGI. So let's start with the bottom and work our way up. For a credit rate of 50% of the contribution to your retirement plan and you are married, filing joint, your AGI can be no more than $39,500. If you're head of household, for that same bit, your AGI can be no more than $29,625. All other filing statuses, AGI needs to be $19,750. Now to go all the way down 10%, it's $43,001 all the way up to $66,000. Anything higher than $66,000 for an AGI means zero. You cannot qualify for the credit. If you are any other filing status besides married, filing joint, or head of household, to get 10%, $21,501 up to $33,000. So depending where your AGI falls, will determine how much of the contributions that you apply to your retirement plan, whether it's an IRA, whether it's a Roth IRA, whether it's a 401k. There's many different types of retirement plans, but depending where your AGI is will determine how much of that contribution can you use as a credit. Okay, next we're going to talk about the foreign tax credit. I talked about this one in the previous video. With the foreign tax credit, you most commonly see it as a credit versus a deduction. This one can be taken either or. I'm going to go into it a little bit more. So the foreign tax credit is for those people that are paying taxes in another country. You pay taxes for a plethora of reasons: property tax, sales tax, income tax, etc. This credit only applies to income tax, excess profit tax, and war profit tax. War profit tax are things like you were in a war and that country did not treat you properly, and so they're giving you a stipend or some sort of payment, or you served in the military for that country and they have some sort of payment plan for you. So if you're going to take it as a deduction, you need to itemize, and so you will just deduct the amount that you pay in foreign taxes in one of your many itemized deductions. Then it will reduce your U.S. taxable income. If you're going to take it as a credit, it will reduce your U.S. tax liability. Most people take it as a credit because the rule of thought is if you have income tax or excess profit tax or even war taxes, your main source of income is probably foreign or even split between the United States and another country, and therefore the standard deduction will be more than enough, and it will probably be very difficult for you to meet that standard deduction if you are itemizing. And so most people then just take it as a credit. But of course, reducing the amount that they can even tax to you is obviously ideal. Just in this situation, it just seems generally more profitable to use the foreign tax credit as opposed to the deduction. So to figure out this credit, you're going to take your U.S. income tax and you're going to multiply that by your foreign source taxable income over your worldwide taxable income. And then you will get your foreign tax credit. So if you are making money in multiple countries, this is how you would apply it. So let's imagine my U.S. income tax is $10,000 and I made $100,000 of income in another country and $50,000 here in the United States. So my foreign source income is $100,000 and my worldwide source income is $150,000. I divide 100 by 150, I'm at 66%, 66.66 bar, and I multiply that by my U.S. tax, which is $10,000. So my total foreign tax credit would be $6,666. That's a nice credit. So the next credit, we have excess Social Security credit and RRTA credit. This credit is used for individuals who work for employers that are not required to withhold Social Security. Some federal and state governments do this, and then people opt to withhold it themselves, and if they've withheld too much, they can claim a credit. And of course, with the RRTA, if you have two different employers and one's a tier 1 versus the other being a tier 3, and they've withheld independently the Social Security, you are now able to claim this credit. It's a complicated credit, but not used often. Okay, so our next credit is a credit on a tax of undistributed capital gains. This is specific to mutual funds. So mutual funds always report your capital gains on a 1099 div. And sometimes all of your capital gains are not distributed to you. They're held by the mutual funds, and when the mutual funds hold your capital gains, they pay taxes on it. And so this credit is to avoid the same amount of income being taxed twice. And so you still need to report your undistributed capital gains, but then you can get a credit for the amount of taxes because the mutual fund will be paying taxes on it, and it gets pushed down to you anyways. Okay, so our last credit that we're going to talk about is a non-refundable credit for the prior year's minimum tax. If you pay an AMT, alternative minimum tax, in the previous year, but this current year you are not paying an AMT, then you can use the credit. It's very, very important that you realize it is not for people that just pay AMT. It is for people that paid in the prior year, and this current year they are not required to pay AMT, and so they can claim the credit for the current year. It varies depending on your AGI and how much AMT you have to pay, but this is the general idea. Alright, that is it. We have discussed all of the income and savings credits. Next video we'll talk about the homeowners and also education credits. If you want to check out our previous video about family independent credits, I welcome you to do so. The links will be below. Have a great day, you guys. If you have any questions, please feel free to contact us at info@lgtservices.com. Filing status.